Are you tired of the stock roller coaster? Waking up every morning, heart racing, checking your portfolio only to see a sea of red? Yeah, I've been there. Investing can feel like navigating a minefield, volatile markets, unpredictable stock movements, and the constant fear of making the wrong choice. Many investors struggle with analysis paralysis. Too many stocks, not enough time to research. Emotional investing, buying high out of FOMO, selling low out of panic. The good news? There's a smarter way to invest, one that reduces stress while still delivering strong returns. So, you're probably wondering, what exactly are index funds? Think of them as the autopilot of investing. When you buy an index fund, you're essentially buying a tiny piece of hundreds of different companies at once. These funds track specific market indexes like the S&P 500, which includes 500 of the largest US companies. Instead of trying to pick the next Amazon or Tesla, hoping you get lucky, you're investing in the overall growth of the market. Index funds are like the set it and forget it method of investing. You don't need to be glued to your screen, analyzing every market fluctuation. They're designed for steady, long-term growth, not get-rich-quick schemes. Now let's talk about risk. We all know investing comes with some level of risk, but index funds minimize that risk through diversification. Think of it like this. If you put all your eggs in one basket and drop that basket, well, you're out of luck. But with index funds, your eggs are spread across hundreds of baskets. One company might have a bad quarter, but it's unlikely that all 500 companies in the S&P 500 will crash simultaneously. This diversification means your portfolio is inherently more stable. When it comes to investing, fees can be a silent killer of your returns. You work hard for your money, and the last thing you want is to see it eaten away by high fees. That's where index funds really shine. They typically have much lower expense ratios compared to actively managed funds. Actively managed funds have a team of analysts constantly buying and selling stocks, trying to beat the market, which comes with higher fees. Index funds, on the other hand, are passively managed, meaning they simply track the underlying index, translating to lower operating costs and lower fees for you. Now I know what you're thinking. Can index funds really deliver the returns I'm looking for? Well, let's look at the historical data. Over the long term, the stock market has consistently trended upwards. Sure, there are dips and crashes along the way, but overall, the market goes up. And since index funds are designed to track the market, they've historically delivered solid, consistent returns for investors. While it's true that some individual stocks might outperform the market in a given year, it's incredibly difficult to consistently pick those winners year after year. Index funds take the guesswork out of the equation, providing a steady, reliable way to participate in the overall growth of the market. Now I know some of you might be thinking, but where's the excitement in all of this? Where's the thrill of picking individual stocks and watching them soar? And I get it, there's a certain allure to being an individual stock picker, to diving deep into a company's financials, understanding their business model and having the confidence to say, this is the next big thing. If you enjoy research, have a high risk tolerance, and the market is your passion, then picking individual stocks can be incredibly rewarding. It's like being a detective, piecing together clues, looking for undervalued companies with the potential for explosive growth. But with great reward comes great risk. Individual stocks are inherently more volatile than index funds. When it comes to individual stocks, you're essentially betting on the success of one single company. And while diversification is essential with any investment strategy, it's especially crucial when you're dealing with individual stocks. If you invest in only one or two companies and one of them goes bankrupt, your portfolio takes a significant hit. That's why it's crucial to diversify your stock holdings across different sectors, industries, and market caps. But even with diversification, individual stocks are inherently more volatile than index funds. The stock market can be an emotional roller coaster, and it's easy to get caught up in the hype or panic. Picking individual stocks is not for the faint of heart. It requires time, effort, and a deep understanding of financial statements, market trends, and industry analysis. You need to be comfortable reading balance sheets, income statements, and cash flow statements. You need to stay up to date on industry trends, competitive landscapes, and macroeconomic factors that could impact a company's performance. Now, if you're passionate about investing and enjoy the research process, then this might be right up your alley. But if you're short on time or don't enjoy digging into financial statements, then individual stock picking might not be the best fit for you. So which one will it be, index funds or individual stocks? The answer, my friend, is up to you. There's no one-size-fits-all approach to investing. The best strategy is the one that aligns with your financial goals, risk tolerance, and time commitment. Choose index funds if you want steady, reliable growth without the constant stress of stock picking. Choose individual stocks if you love the thrill of the hunt, enjoy researching companies, and don't mind a little extra risk for the potential of outsized returns. But here's a secret. You don't have to choose just one. Many smart investors, myself included, opt for a blended approach. We build a solid foundation with index funds, allocating around 80 to 90% of our portfolio for steady long-term growth. Then we spice things up with a smaller allocation, around 10 to 20%, dedicated to individual stocks. This blended approach offers the best of both worlds, the peace of mind that comes with index fund investing and the excitement of picking individual stocks. So, there you have it, the ultimate showdown: index funds versus individual stocks. We've covered the pros and cons, the risks and rewards, and now it's time for you to decide, what's your investing game plan? If you're tired of the stock picking stress, index funds are the ultimate game changer. But if you thrive on the thrill of the hunt, select stocks wisely and keep them as a smaller part of your portfolio.